Hi, it's Hans Lesklimt. Today is Wednesday, July 1st, 2009. And as you can see, we have amazing weather here in Oslo right now. We got like 30 degrees Celsius, sunshine, and it's just astonishing. And we are enjoying it while it lasts, because it won't. And when the summers are nice here, we spend time outdoors and enjoy it as much as we can. Well, back to the markets. That's what I wanted to talk about, and some market comments right now. Well, if you've been following Farman, you know that we have predicted that we will see another down leg and a serious retraction from the gains that we've seen during the second quarter of 2009. And our philosophy and our reasoning is that the volatility that must come from the easy monetary policy that's being followed by all the major central banks must necessarily give a wiggling and volatility that sooner or later will dynamically turn into a selling spree where the markets will go down. We will not have a stable market. We will have tremendous volatility is what we think is ahead, and some of that volatility will go down. We think we've already seen some of this volatility on the upside. That is what we've seen right now during the second quarter, and we still see very strong markets, and we believe that is part of the volatility, but it's an upward volatility, and it will be met by a downwards movement once the volatility and the dynamics of the volatility turns around and goes into reverse. Because this recession that we are calling as a depression is by far over. The worst is yet to come. And the losses that are ahead for the banks, for the financial institutions, for capital markets are still enormous. I mean, capital values around the world are still very, very high. Housing prices are high. Stock markets are high. And this is due to a secular trend that's been going on for, our lifetime. We've seen capital values go up and up and up, especially because interest rates have been going down. And these are trends, very long-term trends, and things that have now changed with the crisis that we came to. The whole world, the monetary system of the whole world is pretty much now run by inflation targeting. We have a regime now with low inflation as the stated goal of a lot of central banks, and even the central banks that don't state it explicitly, like the Federal Reserve, still follow closely a low inflation policy because they are so tightly connected with the rest of the world and the policy of the other central banks. Well, we don't really know. I mean, this has been going on for not very long. New Zealand started, and then most of them came aboard in not that long ago, 10 years ago until now. And we don't really have that much experience with that kind of inflation targeting policy. And this inflation targeting is extremely important to get, because this is running the monetary system, and the monetary system is running the economy. So, this has always been the approach of Farman. We take very much a top-down approach when looking at the economy. And doing a top-down approach, we start by the largest institution of all, which is the U.S. government. And it is the monetary policy there is run by the Fed. So we start out pretty much with the U.S. government, the political framework there, the Fed, and then the other governments and the other national banks follow. And then much later we look into commodities or trends, and even further down we look into specific countries or even specific sectors or companies. In Farman and me particularly, I'm not really even that interested in particular companies, because it's so far down the value chain that it's not where I put my resources. I'm very much a top-down analytical approach to all of this, and a macro perspective, if you like, even though I don't like that word. So monetary policy and a top-down, a broad perspective is where Farman comes from. Well, okay, back to inflation targeting, where we were. And the thing with inflation targeting is that it fixes a goal or a target for the economy, which is the inflation target. In Norway, we have an inflation target of 2.5%, and most of the countries of the world, they're in between 2 and 3%. Well, then the central bank will be hell-bent on getting that inflation to work. And this is crucial because they will adjust monetary policy to achieve that inflation, come what may. You know, the rest may go as it pleases. And when you have a situation like right now, where you have a major disturbance and a major shift in confidence in investors' ability and willingness to put capital on risk, you have a major change in the economy. That would normally mean to a change in interest rates, in inflation, in pricing in the economy, in relative prices. But since the central bank is hell-bent on keeping the inflation target, they will adjust the amount of money and monetary policy in order to try to achieve that. So you have this enormous change in the economy, and then the price level is not allowed to change. So they want to keep the price level even though the real economy changes tremendously. And then what happens is that since we have a lack of trust and people are selling, people want to go into cash, they feel their cash positions are too low, they sell. And this means that prices are going down. The relative value of money, cash, is going up, if you like. And that would mean, normally, that prices would fall out in the market. And we see that on some kind of assets. You know, we saw it in the stock market. We see it in capital goods like houses. But we also see it in some consumer items, you know, expensive big-ticket items like refrigerators and CD players and big flat-screen TVs. Stuff like that are actually falling in price because the demand is lower. But you know, when TVs, flat TVs are falling in price, then the consumer index is falling in price. So what does the central bank do? Well, the central bank does not like to see that the consumer index is going down because they are hell-bent on this inflation target of 2.5%. So they then will work to partly offset the fall in the price of whatever is falling, but they will then need other prices to rise in order to compensate for whatever is falling. And right now we're seeing, you know, especially exporters in China, in Asia, in Japan, in Taiwan, they're dumping their stuff to sell more because demand is lower. So the stuff we're importing is falling in price as a very broad general rule. And what the central bank will then try to do is to increase demand for domestic goods and have that go up in price to compensate for the falling price of other goods. So what then happens to the average consumer is that you will probably not buy that big expensive refrigerator. You'll offset that. But the price of bread and milk and sugar and the things you do buy will go up to compensate for the lower price of the refrigerator, because the whole consumer price index is backwards looking. It's lagging in time, so it doesn't really adjust for the changes that people make when prices change. Only very slowly is this picked up. So if you feel that prices are going up, you are very much right. Prices are going up because the central bank is pumping in money in order to get more demand and higher prices to compensate for the lower prices. Well, okay, it's just one of the perverse effects we have of this central bank policy and central banks all over the world printing money. So the other problem with this is that the new money that's being pumped into the economy is pumped in a very uneven fashion. It's not like this new money that's pumped in to keep up prices is being distributed equally or proportionally or even fairly. Far from it. It always reaches someone first, and this someone is always the benefactor, and who's paying the price is everyone who's getting that money last or not getting it at all. And these kind of disturbances that has been going on during this crisis now are very dramatic, and we have not seen the full consequence of all this yet. And there will be volatility, there will be shakeups in the market, and you can rest assured that some of that sooner or later will bring a major down leg. So don't go into equities, keep out I've been advising to go short in the market, but I hold that. I still hold it. So keep watching the videos and I'll tell you when I think you should short.